Hey everybody, Marty Mazur. Good afternoon, April 27th, 2016. Little commentary for you. I'm going to talk just for a minute or so about the Fed meeting today and the market's perceived reaction to it, and then show you a couple of charts that I think are interesting. So the market ended up, I think the Dow was up about 50 points today. The NASDAQ was down notably, although not down nearly as much as it was on its lows, and that was mostly about Apple and missing their earnings estimates. I talked about that in the television interview this morning. I don't want to take time on that here. If any of you have more interest in it, send me an email and I can even give you more color on what I think is going on at Apple. But I think I covered the gist of it in the television interview this morning. But again, that explains some real weakness in the tech sector. And again, Apple's a big part of the major averages. Despite Apple, though, being in the Dow was up, S&P was up a little bit. The Fed, as expected, did not offer up anything that was too frightening to the markets. It'll be interesting to see what goes on in the June meeting. There's a few analysts, Bank of America happens to be have one of them or some of them, who have a base case for the Fed raising in June. I've maintained that that's a very low probability, largely because of the uncertainty of the referendum in Great Britain. I would have to say, though, if the polls start showing that it will be a decisive victory for those who want to stay, if it's clear that there isn't going to be an exit and the world believes that, then that gives the Fed, I think, more of a green light. They won't say that something like that will sway their votes, but I can virtually guarantee you that it would. If anything that whiffs of potential global uncertainty in today's environment is an issue. So, but they could very well get a little more hawkish, and there's some, there's a little bit of the language there, a little less concern about the international developments they suggested. They talked about the improving labor market, but I think they did what they what they wanted to do in the statement, or Janet Yellen did, and that was to quell any concerns right now that might roil markets. Initially, the market sold off, but that was just for just a few minutes, and then I think it just kind of interpreted it the way I just presented it to you and saw that as a bullish development for stocks, at least in the near term. There's less pessimism. I look at things like the put to call ratio, and I was reviewing that this morning. It's dropped quite a bit. So there's getting to be more optimism into the market, and that's clearly pulling money in. Although it's not necessarily what you want. The market tends to do better when there's a higher degree of pessimism. I still think there's substantial short interest. We'll be getting our 2-week report here pretty soon. That could lead to better things as the market turns higher, and I could continue to ramble, but again, as I said, I want to show you some charts, and I want to keep it relatively quick. So in front of you is the one you're getting used to seeing. This is the 1-year daily chart. These blue lines, these show downtrends that come off of the peak last May. And this one is one that the S&P is clearly dancing around. It got above it, stayed above it for a couple of days, then failed, and then has lived kind of below that line. And then today, I think with the optimism, or at least the market's optimistic view of the Fed statement, we closed just above that. So that's going to be interesting to see. You can see the sloping wedge pattern that we have here, and we've got a little room to go before we start testing that one, and then of course the all-time high. The breadth across sectors, as I suggested, has been strong. It's just remained strong, if not gotten stronger. That's a very good intermediate term. Right now, all 10 S&P 500 sectors are trading above their 200-day moving averages. In a nutshell, that's just a very bullish breadth reading. If you go back historically, when we've had that kind of breadth, and you look out 6 months, market's been in pretty good shape. But as you well know, this market has some potential headwinds, not the least of being the U.S. election. I mentioned the referendum, and then the Fed probably needing to raise rates once or twice later in the year, and valuations that aren't cheap at these levels. So I do think there's reason to be optimistic from a breadth standpoint again. But as I keep saying, in the near term, these technicals are telling me that we probably, or there's a good chance we'll see the market come down and consolidate some of these gains at some lower level. I've been saying that for a while now, and it's not happening, and it certainly doesn't have to happen. There can be enough confluence of positive events, better earnings going forward, that could keep us in this on this trend going up into and beyond all-time highs. One of the technical indicators, just one, and one of my favorites, is the MACD line, moving average convergence divergence. It's basically a momentum oscillator, and it sends some pretty good signals. Nothing's right 100% of the time, and this is the daily chart. We can push out further and go weekly, and it's a little smoother. But right now, this is suggesting to me that this rally is petering out. You notice the trend lines here, but you might notice the MACD is trending lower. There's some other examples here where it was giving a counter signal. Here's where the trend line was flat from that bottom to that one, but the MACD was giving a strong bullish signal, and look what happened in terms of the rally. Exactly the same thing here. But then here, as it petered out, a little more decisive than this one here. It didn't have the Fed as accommodative in here. In fact, this was right before they raised rates. But you see that shape looked very much the same, and now it may be giving up the ghost a little bit, but we'll see. Folks, this is not a market timing talk. This is not something that I think we need to accommodate for. This is just me helping set your short-term expectations. Now, I wanna just add here before I close a little more detail for you. I mentioned breadth. Let's look at it in a little different way, and let's look at it from a relative strength standpoint. I know there's a lot on this chart, but I'll just point with the cursor. Financials. Now see the green line moving up. What this line is it's the financial sector exchange traded fund, XLF, relative to the Standard & Poor's 500. When the line is sloping up, financials are performing better than the S&P is. So if this is a year-to-date chart. So if you go back to the beginning of the year, you can see financials really suffered relative to the broader market. Kind of bottomed there and then went sideways. Lately, financials went up. And I'll tell you, when I give you all of them, I'll tell you my conclusion. Consumer staples, on the other hand, started with great relative strength, and it's been failing of late, as has technology. And last night's Apple's earnings certainly haven't helped, but you notice the relative strength actually in technology was very strong just until lately. Consumer discretionary started out pretty strong, failed, and has just been kind of sideways since. Now, materials started lower, bounced, and have just been inching their way higher, and more so lately relative to the S&P 500. Energy stocks, very strong relative strength. Natural resources, this is the ETF we use, GNR, which is the S&P Global Natural Resources Index. It has energy, but it also has copper and other resources too. These signals from these three, historically speaking, can be or have been pretty good signs, pretty good precursors to expansions in the global economy. I think it's too soon to fire the starting pistol or set the pigeons loose. But this is a signal that some of the data, well, mixed. Last night we had some pretty good data from China, that the market is beginning to discount certainly a bottoming in the commodities complex and maybe better things going forward. This to me is a very strong sign for financials. And when I do the technicals on each one of these sectors, financials remains very strong and a very good up pattern. The MACD for financials looks very strong as well. So while I'm guarded in the short term, and my charts are telling me that I should tell our clients if they want to expect something in the near term, expect maybe some weakness from here. It doesn't have to come true, could very well be wrong. But longer term, intermediate to longer term, notwithstanding the headwinds I talked about, there's some readings that are kind of encouraging in this market. There's another one I wanted to show you. We have been global investors for a long, long time. And that, the last few years, with a few exceptions here and there, hasn't been helping our portfolios relative to the S&P 500. Now, they've done fine, but not quite like they did from 2000 to 2010, where consistently there was a notable outperformance of the S&P 500. And it wasn't because we did a phenomenal job of stock picking, it's just because we're global. And the non-US places, or the non-US positions, outperformed the US pretty consistently. Now, this chart is kind of like, it is the same as what I just showed you, only this is the developed market index, Europe, Australia, the Far East, and this is emerging markets, and this also is year to date. So you can see we started out pretty much the same here, but of late there's been a big move and a big improvement in relative strength for non-US developed markets. There's also been, pretty much from right after the beginning of the year, 2 weeks in, a huge relative strength advantage or signal coming from emerging markets. again, speaking to the potential going forward, and I'm thinking longer term now, a pickup in the global markets or in the global economy. Another chart I looked at today that I didn't load for us here is looking at profit margins. The U.S. Pretty much peaked at record profit margins a few months ago and has kind of been trending lower. Both the developed non-U.S. and emerging markets are substantially below where profit margins last peaked in 2007, which is where they also last peaked for the U.S. before reaching all-time highs. That's another sign that there could be some real catch-up from the non-U.S. markets versus the U.S. market. So what I'm doing there, folks, is just justifying our maintenance of, or our maintaining, if you will, of global exposure in our portfolios. That went longer than I expected. Hope that was valuable to you. And of course, I'll be back very soon. Thanks as always for watching and listening, and I'll see you later.